On August 9th, 1965, a country with no army, no water, no oil, no farmland, and no reason to exist was told to survive on its own. Investors didn't flee because Singapore was poor. They fled because it didn't make sense. There was nothing to invest in. No natural resources, no domestic market, no safety net. Just a swamp, a port, and a lot of uncertainty. And yet, something strange happened. Before Singapore became rich, before the skyline, before the numbers, global money quietly started trusting it, not loving it, not believing in its future, trusting it. That difference changed everything. Because in finance, trust comes before wealth, and that's the uncomfortable part nobody likes to admit. This story matters right now because we live in a world where money moves faster than governments, faster than voters, faster than laws. Capital doesn't care about speeches, it cares about rules. And Singapore built rules so tight that money felt safer there than in countries 100 times larger. Now let's rewind. In 1965, Singapore was expelled from Malaysia. Not by choice. Kicked out. Overnight, it lost access to food supplies, water sources, and its defense. Unemployment was high, housing was overcrowded, and the tensions were real. By every textbook definition, Singapore was a bad bet. If you were an investor, this wasn't high risk, high reward. This was just high risk. So the question isn't, how did Singapore get rich? The real question is, why did anyone trust it before it did? Because money doesn't wait for success. Money places bets before outcomes are visible, and Singapore understood that earlier than almost anyone. Most countries try to attract investors by promising growth. Singapore didn't. It promised us something way more: rules that wouldn't change. Here's the simple idea that powered everything. Imagine you lend money to someone. You don't care how passionate they are. You don't care how smart they sound. You care about one thing. Will the rules protect you if things go wrong? In the 1960s, most newly independent countries were rewriting laws every few years, nationalizing industries, changing tax codes overnight, redefining property rights. From an investor's point of view, that's chaos. Singapore did the opposite. It froze the rules. Contracts would be enforced, property would not be seized, courts would not bend to politics, and corruption, this is critical, would be punished fast and publicly. Not with speeches, with jail time. This wasn't moral idealism, it was economic math. Because corruption is just an invisible tax. If you don't know how much it costs, you can't price risk. Singapore made corruption expensive and predictable. That alone lowered the cost of capital. Then came the second move. Singapore didn't try to build national champions. It didn't protect local businesses just because they were local. It treated foreign companies like guests who paid rent. You bring capital, you follow the rules, you get stability. No special favors, no political bargaining. That sounds obvious, it wasn't. Most governments see foreign investors as temporary tools. Singapore saw them as long-term partners with boundaries. And this is where the irony kicks in. Singapore wasn't democratic in the way Western investors claimed to value. Speech was controlled, protests were restricted, the press had limits, and yet investors trusted Singapore more than freer societies. Why? Because predictability beats freedom when money is on the line. An investor can price control. They can't price chaos. Now here's the hidden mechanism most people miss. Trust compounds. The first investors didn't come because Singapore was successful. They came because the rules worked once. Then twice, then 10 times. Each successful transaction became proof, and proof attracts more capital than promises ever could. By the 1970s, Singapore wasn't selling opportunity, it was selling certainty. And certainty is rare. Let's talk numbers, briefly. In 1965, Singapore's GDP per capita was comparable to some of the poorest countries in the world. By the 1990s, it had overtaken many developed economies. Not because productivity magically exploded overnight, but because capital flowed in cheaply. Lower risk means lower interest. Lower interest means more investment. More investment means faster growth. This isn't inspirational, it's practical. But here's the uncomfortable math. Singapore achieved this by making the state extremely powerful. Laws were enforced strictly, punishments were harsh. Compliance wasn't optional. Efficiency replaced debate. This reduced uncertainty, but it also reduced tolerance. The hype version of this story says discipline created prosperity. The reality is harsher. Discipline created trust. Trust attracted capital. Capital created prosperity in that order, and that order matters. Because many countries tried to copy the discipline without earning the trust. They enforced rules unevenly, protected elites, changed laws when convenient, and investors noticed. Singapore didn't succeed because it was strict. It succeeded because it was consistently strict. That consistency became its real natural resource. Now zoom out. This raises a disturbing question. If money prefers predictability over freedom, what does that mean for the future of global finance? As capital becomes more mobile, countries will compete less on values and more on control. Rules that don't bend. Systems that don't apologize. That's not a moral statement. It's an observation. Singapore didn't prove that authoritarianism creates wealth. It proved that money flows to wherever rules feel safest. And safety in finance doesn't mean kindness. It means reliability. So here's the unresolved question. In a world where trust is more valuable than resources, and predictability is more valuable than democracy, how many countries will choose stability over openness? And what will that cost them before the bill finally comes due?